welcome to our 9th ATILA lecture. It will be on insurance, climate change, and the law. And we have organized it on the occasion of the publication of a book by one of the speakers, FRANZISKA ARNOLD-DWYER. Her book with the same title, Insurance, Climate Change, and the Law, is just appearing. And this is why we use the heading of new in the bookstore. And it's a new format of these ATILA lectures, and I think it's a good one, and we probably will have it again at some other occasion. I am very happy that we were successful in attracting very renowned lecturers. We have announced the author of the book, FRANZISKA, as a first lecturer, and MARYAM GOLNARAGHI as a second lecturer. When we discussed in preparation of this event, it turned out that it might be better to present the other way around. And so we will actually ask MARYAM GOLNARAGHI to give her lecture first, followed by the presentation of the book by FRANZISKA ARNOLD-DWYER. MARYAM GOLNARAGHI will talk about long-term insurability of physical climate risk. She is the Director, Climate Change and Environment with the Geneva Association. We are very grateful to have her with us today. FRANZISKA ARNOLD-DWYER is a senior lecturer at the Queen Mary University of London, and she will present the title of her book, Insurance, Climate Change and the Law, the Role of the Insurance Industry. And the whole event will be moderated by MARTA, who is a postdoc researcher at the University of Zurich and the General Secretary of our global research network on the principles of reinsurance contract law. And having said this, I will pass on the word now to MARTA and ask her to start the contents of this meeting.
Good afternoon. Thank you. Good afternoon to everyone. Thank you, Helmut, for this introduction. It is my pleasure to moderate today's lecture. The topic of the lecture is super interesting and on top of every agenda at the moment. So I'm really looking forward to listening to our two outstanding speakers. Before we dive into the presentations, please let me give you a few housekeeping announcements. First of all, today's webinar is being recorded. We will be able to share a link with you after the event is complete, and we also welcome you to revisit the content yourself on our YouTube channel and share it with your colleagues if you wish. We also invite you your comments and questions. Towards the end of each presentation, we will have a short Q&A session. To pose a question, please use our Zoom chat box. If you think of any question you want to ask for our speakers at any point, just type it in there, and then I'll pose it to our speakers at the end of their presentations. All right, I think this is now time. I'm going to hand the floor over to MARYAM, who is going to start today's presentation. MARYAM, the floor is yours.
Thank you very much, and thank you very much for the kind invitation. I'm thrilled to be in a forum where we have practitioners and experts from academia to join together to look at some of the issues. Let me share my screen first with you. Hopefully technology will deliver and put this. What I decided to, let me just see, excellent. What I decided to do today goes far beyond actually just looking at insurability of physical risk. What I decided to do is to showcase some of the research that we've conducted over the last 3 years, of which obviously physical climate risk is a critical part of. But just bear in mind that I will be launching a major initiative around insurability of physical risk this May, because it's a concern that, to everyone, with insurance leaving or being forced to leave some markets. Obviously, this is raising great concern among people. So what I'm going to be looking at is boosting insurance industry's contributions as risk managers and as investors to enabling a more resilient and decarbonized economy. What I will do is I will do a quick review about my think tank, some critical developments that is shaping our transition to a resilient low carbon economy. And I will do a very sort of broad overview of three critical topics that I've been leading in the last 3 years. And I will share with you all the reports so you can dig deep into these reports. But I want to share sort of how all these issues come back and ultimately link to the field of law, also requiring extensive amounts more research as we look ahead. Those topics, first one is extensive work we've done on classification of climate litigation against corporations and governments and implications for insurers as risk managers, that's the P&C side, on the liability side, as investors and also implications for their boards. Second topic just touches on financial risk of climate change, particularly with the emergence of the Task Force on Climate-Related Financial Disclosure and related regulatory developments, but how we have really worked with regulators and the industry to try to shift that dialogue and action towards more robust information to support decision-making. And then the third one, which I was up actually the whole night, maybe I slept 2 hours because this is right about to come out. I was just looking at the edited version. It's a very exciting work that I have led over the last 18 months with leading insurance companies, US Department of Energy, Breakthrough Energy, which is the biggest investor in climate technologies such as green hydrogen and others, to enable decarbonization of industrial sectors, hard to abate. So how does insurance come in and what kind of transformative action is needed to help expedite these fields and ultimately the link to law? So this is what I'm showing you is our board of directors. We are actually in transition. We are filling 4 board seats. So this is not the complete board, but just to highlight for you, Geneva Association is the strategic think tank of insurance industry. It was launched in 1973 by former Prime Minister of France, who was a CEO and executive of insurance company. Essentially, we work on highly strategic issues with a view to the future that either will impact the insurance industry or the insurance industry plays a big catalytic and enabling role. And obviously, my area being climate change and environment is one of those topics. And I will be able to share with you some of those strategic ideas that I share with the board, I discuss with the board, and ultimately I implement through extensive industry collaboration and engagement with other critical sectors through partnerships. Now, getting into the essence of what I'm sharing with you today, my career spans 25 years. I'm a climate ocean modeler by sort of educational background, but I have worked in public sector, private sector, and I was head of a major UN program. So what I'm combining to share with you here comes from, all that experience plus my last 7 years at the Geneva Association. And what I can tell you, having been deeply involved in the field of climate change, originally from science and subsequently on the management and policy side of it, is that really it's over the last 5 years that the climate change debate has sort of shifted from an environmental, scientific, or a corporate social responsibility issue to actually a main driver of socioeconomic development, energy security, innovation, and quest for trade leadership, and also a major consideration for stability of financial system. So you see a serious paradigm shift in the way climate change is being spoken about just in the last 5-6 years. Now, I wasn't sure about the background of the audience. So here I have just put few definitions that I will refer to repeatedly. I will be referring to physical climate risk, which is comprised on how climate change is shifting severity, frequency, and occurrences of extreme weather events. And chronic risk, it's about long-term trends of climatic conditions such as sea level rise and so on. So when I refer to physical risk, that's what I mean. Transition risk are risk associated with transitioning to a low carbon economy, decarbonizing the economy, which would involve unknowns about policy, unknowns about market behavior, and the supply and demand side, unknowns about technology disruptions, reputational risk. And then there is litigation risk, which typically is identified really as liabilities associated with climate change, but we have expanded that definition to the definition you see here. So now looking at the trends, I just want to raise to your attention that only in the last maybe 4 to 5 years, you see 7 critical recent trends that's really shifting the whole perspective on the scale, scope, and the speed of economic decarbonization. So first of all, I would say, particularly following the severe summer of 2022 in Europe, there was a major shift in the geopolitics of energy security. For many of you that are European-based, you remember extreme heat combined with technological problems associated with nuclear power generation, and then deficits in hydropower combined with the Ukraine war led to significant fear about energy security in Europe. Now, that really sent a very big signal globally, where you started seeing that countries around the world started to develop and issue their national critical material strategies. This is rare earth and critical metals that are needed for development of new technologies, renewables, and others for energy transition. Second major developments happened about 2 years ago with the emergence of what I call transformative public policy and government subsidies, starting with the Inflation Reduction Act and the Bipartisan Infrastructure Act in the United States, and subsequently that led to speeding up of the EU, the Green Deal legislation, and also sort of that resonated around the world. And we've seen all of a sudden, in a matter of 2 years, availability of quite extensive amount of government subsidies to support the transition. The third one is around the coalitions that have come together, such as the First Mover Coalition of companies and governments, to really start enabling development of markets for the energy and industrial decarbonization transition. Fourth is how capital is starting to come together in a much more coordinated way to be deployed towards the transition. And I like to highlight 2 developments. One, obviously, is the Glasgow the financial group on net zero that was sort of spearheaded originally by Mark Carney, being the group of organizations that have the intention of deploying about $400 trillion dollars into the decarbonization. And that's also linked to the sustainable finance development taxonomy and recommendation, which I will get to. But very importantly, through a network that is referred to as Breakthrough Energy, chaired by Bill Gates, the highest net worth individuals, philanthropic families, and now corporations and governments are coming together to pool funds to start deploying those funds towards development and deployment of climate technologies such as green hydrogen, carbon removal storage, modular nuclear, et cetera, to expedite their deployment. Obviously, there is a sustainable finance field. I think maybe Franziska will get into it in a more details, but related taxonomy, what does it mean to invest in green, and then the regulations, which I will also get into. The sixth one is in development of climate technologies, and very importantly, what we call climate tech hubs, hydrogen hubs, carbon removal hubs. These are hubs where the producers and the customers are coming together to create markets. They're also working to develop the supply chains and infrastructure system for the transition. And last, but absolutely not the least, and to me, one of the most important thing is the deployment of what is called the Adoption Readiness Framework by US Department of Energy, which looks at 17 critical risks that's holding back deployment of new technologies, particularly focused on expediting industrial decarbonization, and I'll get into that. Now, let's look at the risk landscape. It's very complex. I mean, I remember way back when I was working in my company supporting development of NatCat models for the insurance industry in late 80s and 90s. And the picture of risk has become a lot more complex. What we've captured is direct risk, how a peril impacts the asset. And we don't even have a full picture of that, let alone the indirect risks of physical climate risk and the compounding effect of it, how physical climate risk, develop of floods, droughts, severe storms, fires could actually not only impact people and assets, but they can impact the supply chain, they can lead into business interruptions, etc., which we are not capturing in our models. Past is no longer a good reflection of future. So as we try to capture hazards, exposures of our assets and their vulnerability, we need to turn that into a forward-looking approach. And this is not a simple problem. It's not a deterministic problem. It's one of the most challenging forward-looking stochastic problems because of the inherent uncertainties associated with the transition. So what are we going to do? We need a whole new generation of risk analytics tools to be able to really capture materiality of climate risk on our business model, on our assets, and subsequently be able to make good decisions to steer the companies or to steer the country under such inherent uncertainties. We are also starting to hear more and more through different players in the system of the importance of risk prevention and risk reduction. That's the only way that we can keep the risk manageable and make sure that insurance is available and affordable when it comes. So building resilience and adaptation measures is foundational. And, I have, witnessed how over the last maybe 7 or 8 years, the recognition for role of insurers has really grown among governments and businesses and so on. Essentially, sort of my motto has become no insurance, no investment, no project, no transition. So now let me jump into 3 topics. Now I'm going to try to fly through these because I only have, a limited time to talk to you. But what I'm going to be telling you is underpinned by extensive research. And I also have highlighted the reports. So if you're interested, you can dig a lot deeper. But I just want to give you a flavor of all the new developments that may not be on a company or on the government's radar. And these are some of the issues that I discuss with our board, and we try to stay 3 to 4 to 5 years ahead of the market. And one of those areas was emergence of climate litigation risk. So this is the work I launched in 2020, and we published 2 major reports in 2021. These reports, the first one is about the landscape of climate litigation risk, which is public. The second one, we took 2,000 litigation cases in a team of 6 practitioner lawyers, 1 academician, and a team of 30 experts in risk management. And we tried to sort of characterize sources of climate litigation against corporations, governments, and subsequently, what does that mean for insurer as a risk manager, as an investor, and for the boards? This work, actually, the second report is confidential. One of my CEOs told me that, oh, you've developed the cookbook of how to litigate against corporations and governments. But that's the kind of detail, that's the kind of classification we know to try to prevent it, to understand why litigation is coming about. And what you see, the source of the reason for litigation is not just for those who incurred or potentially, or they're perceived that they have incurred a loss to try to, get their claim for their loss. It's actually becoming a powerful tool to push governments and corporations to behave in a certain way, either to push for climate action or to prevent climate action, interestingly enough. So just very quickly, when you look at the emergence of climate litigation, since 2015, following the adoption of Paris Agreement, the cumulative number of climate change related cases have more than doubled. Orange are cases in the United States, blue are cases everywhere else. The thing that I wanted to say is around 1/4 of these were just filed between 2020 and 2030. So this field is really, picking up. Essentially, these litigations are against corporations and governments. We identified 8 key drivers of why there is rise in expansion of climate litigation, increased awareness, that people are starting to really feel the impact of physical and transition risk, increasing climate commitments by corporations and governments and not meeting them, availability of litigation funding. I've actually put some interesting stories in the report of how this funding is coming about, evolving standards of care, climate attribution science, etc. And this is becoming a global phenomenon because of emergence of global databases on these cases, growing legal networks and platforms, and the fact that plaintiffs are using cases from one jurisdiction in the other. Now, this is the part that I can't get too much in because of the confidential nature, but I'm very happy to share this overarching view. What we did is, after reviewing about over 1,800 cases, we broke it up into 3 categories. Sources of litigation against corporations, against governments, but with implications on companies, and then cases where insurers were bringing against the governments, and particularly local governments. I'm going to just to demo to you the case against companies. So we identified 4 main types: lawsuits against companies for casual contribution to climate change, the Exxon case; lawsuit against companies, fund managers, and or their fiduciaries for miscommunication or failure to adapt to climate change risks; lawsuits seeking to force companies to align their emissions with the Paris Agreement. The Shell case is this case. And very interestingly, cases challenging companies' projects or technologies, either if they were carbon emitting, or the project is actually a renewable project, but it's not meeting, for example, environmental standards. So just getting a little bit deeper in these, behind each of these types, there are many ways that litigation can come about. Let me focus on type 2, because my next section relates to this. This is lawsuit against companies, fund managers, and their fiduciaries. These can come because of miscommunication of information. For example, you have claimed you've done something to green the economy, to green your business model, but you actually don't have the business plan yet to implement it, the risk of greenwashing. Or it can be failure to adapt to climate risk. So even under each types, claims can come about, because of a number of different factors. So it's a very complex, cohesive, but yet organized and structured way of looking at these litigations. And then I'm not going to go into this, but what we did is we looked at how these cases would impact a property and casualty insurers underwriting. Unlike the general understanding that litigation is only relevant to P&C, we've also shown how climate litigation could impact the investment side of insurance industry, particularly life insurers that are long-term insurers, and potentially even hit the directors and officers of the boards of companies. Again, I'm not going to go into the details of that. I just wanted to throw it at you so that you see that there is a lot of depth, there is a lot of detail, and ultimately this led to significant recommendations for companies. And over the last 2 years, it has started a whole new wave of litigation modeling and a lot of internal work inside the companies, and also working with clients to try to make sure that they will not be a victim of a litigation. Okay, let me jump into the second case. The second case is financial risk of climate change. Significant regulatory development requiring or sort of to start asking companies to do forward-looking scenario analysis to try to assess financial risk of climate change on their business models. And there are two approaches, inside out, how my actions impact the climate, outside in, how climate impacts my business, and then the reporting requirements. But what we did is I pulled together a task force of 80 cross-sectoral experts from insurance companies, life and non-life, and we pulled in 18 financial regulators for a course of 2 years in a pretty extensive research project that led into 3 reports, plus one that was just published between myself and one of my colleagues at the Geneva Association to dig deeper into materiality of climate risk for life insurers on the liability side. So these reports are all public or available, and you can take a deep dive. So in the first one, we looked at how climate change impacts both sides of the balance sheet of a life and non-life insurance companies. In the second one, we reviewed all the regulatory developments and came back to the regulators for discussions that, maybe these exercises, while resource intensive, is not going to produce decision useful information, neither for the regulator nor for the company. In the third report, we went back to the regulators and challenged them about why they're doing this and what are the critical questions that they want answered. And we linked that to the climate risk assessment exercises of the companies so they can actually ask the right questions to support decision-making, as opposed to just run a couple of deterministic forward-looking scenario analysis, which is useless in light of the inherent uncertainties of climate change and transition as we look ahead. And in the last report, we took a deep look at what are the challenges for life insurers on the liability side to try to do material analysis of climate change. But let me just point to 2 key things here. Number one is when these developments happen, many companies tend to look at their actions on climate, the inside out analysis, and that has led to significant concerns. A lot of these developments are based on science-based approaches. However, we know that the real economy doesn't move with science, and that led to risk of greenwashing and reputational risk. Whereas if you want to collect information, build risk information to steer your company, you need to do the outside-in analysis. How would my business model behave under different climate change scenarios? And this is what we focused in our study. And I would urge you to read these reports, because we are really asking and have sort of launched a whole paradigm shift in the way that you should be thinking about forward-looking climate change scenario analysis. We promoted that this needs to be cohesive, and it needs to link to business functions in the company and we need to look at how risk propagates through the decision loops. It requires a look at different time horizons, etc. And we gave a lot of guidance, and we also surveyed the companies to see where insurance industry lies. But let me give you 2 points. As part of this, we went back to the regulators and we asked them, well, instead of giving us the scenarios, can you tell us what is your regulatory objective? And what happened is we converged from those that responded, we converged on 5 common priorities: policyholder protection, insurers' financial health, corporate governance and strategy, insurability and affordability of insurance, and financial stability. Then we asked them, well, what are the key questions you want to be asking insurance company? What is it you really want to know? And they posed their questions. And what we did is we took these regulatory questions and we mapped it on the core function of the insurance business model. And then we offered the insurance industry a set of organized questions coming from the regulator that are actually foundational questions that the companies need to investigate as part of their forward-looking climate risk assessment. And the goal of this was to really start focusing climate risk assessment on critical issues that can immediately support decision-making. And then we also dug into the governance of climate risk assessment inside the company and its ownership to make sure that these assessments are not done in siloed in different corners of the company, but actually they can be built upon. And we actually offered a whole methodology, which I'm not getting into. So my point of this exercise is, instead of reacting to regulations, we started in a very constructive way to challenge it and try to build a positive relationship between the industry and the regulator to try to dig into these issues and invest the resources to produce useful information that's good mutually for the regulator and for the company. And that has set off the insurance industry to start looking at these issues in a much more effective way. Now, I have only 3 minutes, and I have a whole new area to share with you. So I'm going to tease it a little bit and tell you that one report is out on this, and the second one will be published 4th of April. So I've so far just focused on risks, but let's focus on opportunities and how we can make risk into an opportunity. And that is around how can insurance unlock financing and market readiness of new emerging climate technologies that are going to be foundational for industrial decarbonization. So this is sort of the result of pretty intense 18-month research that, as I said, it was done collaboratively with Department of Energy, with investors, with leading insurers, where we looked at, so this is the first report that is published. It sort of lays out the landscape. I did a pretty major survey with the C-suite of insurance companies on their receptivity in proactively supporting the decarbonization. And report 2 is the how. How do you do that? So just to sort of give you an idea is, what am I talking about industrial decarbonization? We are looking at critical sectors like steel, concrete, cement, trucking, aluminum. Let me just make a step back. Over the last few years, there has been significant information about transition finance, about decarbonization pathway, net zero strategies. We decided we need to bring this on the ground. What does this mean on the ground? What does it mean to actually unlock capital to support projects to make this happen on the ground? So we targeted the hardest sectors, 35% of emissions, and we worked with Mission Possible Partnership, which was originally launched in the World Economic Forum, but now it's an independent entity comprised of governments and corporations, to see what does it take to try to decarbonize these sectors. Where are we today? And where we need to be, when we look ahead in 2030, So we have the targets, but let's take a look at renewables. It took over 4 decades to bring solar and wind out and commercialize it. And even today, these technologies haven't realized their market potential. So how are we going to do this for this whole range of new technologies, green hydrogen, carbon removal storage, modular nuclear, sustainable aviation fuel, et cetera, et cetera? Can insurance play a role? Now, uh, obviously, I don't have time. I'm already done with my time to get into the details. But the essence of the work that we've done is we've identified, working with Department of Energy, 17 risk category that holds back uh, deployment of new technologies for industrial decarbonization. And we have translated those into risk from insurance lens. And what we are doing now, we are working with the community, the stakeholders from climate tech developers, investors, the government on how can insurers step in with their risk engineering expertise from pre-commercialization stages of these technologies to help expedite assessing insurability conditions of these new technologies and expedite development of innovative insurance solutions, because no insurance, no finance, no projects, no decarbonization. And I don't have time to go into the details, but we've already started looking at green hydrogen and carbon removal, and looking at what disruptions need to happen in terms of engagement of insurers at the project level. Currently, they're being called upon when the project has been designed and it's ready for financing. So please tune in on April 4th for this, what I call transformative work that has been inspired by this cross-sectoral collaboration. And these are the new ways of thinking that we need to work together within the industry, across the industry, to really collaborate, to co-develop innovative risk management solutions that's going to help unlock financing and market readiness of all these technologies that we need. And with that, significant amount of support from the legal field in terms of the complexity of the contracts and the way these technologies and business models are evolving. We need to really take a fresh look at this as we look ahead. So with that, I thank you. I was too broad maybe, but I just wanted to share the scale and scope of topics that the insurance industry need to be worried about. So with that, I pass it on to you, Marta, and thank you so much for your patience. I've been 3 minutes over time.
Thank you, Maryam. Your time management was perfect. We actually still have 1 minute left. That was very interesting. I actually read your last report. It is a huge endeavor, to put together industry, academia to get that financing. So I'm looking forward to see your work. Where are you how are you gonna put that project farther, move that project farther? Let me ask you one question regarding the first part of your presentation. You addressed two important risks, especially from the company's perspective: climate litigation risk, financial risk. How they affect the decision-making, regulatory requirements, and so on. And I'm thinking, what do you think? I'm wondering, from your experience, as I know you work closely with both insurers, regulators, supervisors, what do you see as the most challenging in tackling this risk?
Look, I have to say, I mean, I embarked on this. I had the first climate risk analytics firm in the world launched in 1997 in Boston. So, when I look back at where we were and where we are today, not just for the insurance industry, because I think probably from point of view of risk modeling, is an industry that, given that risk is its bread and butter, it has invested a lot in understanding particularly physical climate risk. But given that insurance contracts are annual, insurance companies look at what we call climate risk and not climate change risk, and climate risk being, this year's and maybe the next 3, 4, 5 years risk. And, they have the ability to adjust based on the analytics. So the tools that we have today are very good for that business model. Now, what I see in terms of what the world and clients are going to need in terms of their transitioning, when I look at how projects for the transition are emerging, when you look at like a green hydrogen project, this is what I call a whole value chain project. It goes across lines of business, it goes across jurisdictions, it goes across timelines. So the question that I ask myself, how would the insurance business model looks like 10, 15, 20, 30 years from now? And from there, do we have the risk analytics tools, forward-looking tools, to help innovate, develop, and deliver the solutions that, the society demands from the industry, wants from the industry? And with that, I go back and I say, well, in a world that is, transition that is very uncertain, we don't know how public policy is going to evolve. We don't know how markets are going to behave. We don't know which technologies are going to make it and which ones aren't. With all these unknowns, are we ready to tackle that? Whether it's the insurance company and whether it is the regulator. So my view of it is the only way we can tackle such complex issues and move towards solutions as opposed to just keep focusing on problems is collaboration. And this collaboration has to happen within the industry, between insurance industry and sectors that it's going to serve, and then very importantly, between regulators and the financial sector and insurance industry, because this is not about just imposing a stick. We need to incentivize and give the carrot, right? So how we're going to do that, and it's questionable. So really developing those risk analytics tools that, as I said, can capture the direct, the indirect, the compounding effects, and allows the industry to really understand and better assess those risks to innovate is foundational. And on the other hand, deployment of capital. Many of these things are very risky. So insurance industry is also the investor. But, how do we bring risk management to these projects to mitigate the risk and hopefully, working with regulators to really tackle that cost of capital that incentivizes not only the insurance industry, but pension funds and other regulated institutional investors who really have the money to start investing in the economy. So in a nutshell, we need to shift the paradigm. It's not about reporting. It's about enabling solutions, incentivizing solutions in a responsible way. And it's not about doing it alone. None of us in our companies or in our sectors can do it alone. The innovation will happen only through cross-functional collaboration. And when you see the second part of the report you mentioned, what we've proposed came out of intense 18 months of collaboration of insurance industry with engineering firms, with investors and governments. This is how we put our minds together and said, well, how are we going to carry this forward and who can do what? So those are some of my thoughts.
Yeah, collaboration is a key word, right? But I'm imagining that to put in collaboration so many different stakeholders, it's
time consuming. I think I've gotten an average of 3 hours of sleep for the last 18 months. It's intense, but one of the things that I also noticed in the last 2-3 years, many stakeholders' heart and mind is there. The alignment is starting to happen. players within individual sectors are realizing I can't do this on my own because my work is going to depend on what others. And I showed you a panel of 17 risks that's holding back climate technologies. If we really want to move forward with climate technologies, it's not about the entrepreneur working with the investor. It's about the entrepreneur working with the insurer, with the investor. It's about the supply chain and equipment manufacturer. It's about government being able to bring in the policy and regulations in a timely way. It's about the permitting function to move. It's about investors aligning to putting the, so everybody needs to work in a much more coordinated way, right? It's about the infrastructure operators. If we don't have the infrastructure systems in place, these technologies will not materialize. So that's why you see the emergence of these climate tech hubs, where the supplier, the producer, the customer, the supply chain players, the infrastructure players are coming together through these hubs. So this convergence is starting to happen because that recognition is there that we can't do it alone. But it will take time, for sure.
It will take time, but I see that you are very hopeful that also the outcome will be positive, right?
Otherwise, I would sleep more.
Right.
No, I'm the forever glass is half full person. So I cannot afford not to think that way. Let's put it this way.
Very true, very true. I'm looking at our chat, but I do not see any questions. So, but I also think
say all these reports are available, maybe except one report. So you can access that at the Geneva Association. And if your audience is interested, I would be very happy to put together a reference list that you can avail to them with links to where they can find the reports for digging deeper into the issues.
Okay, so we invite everybody to visit the Geneva Association website for the reports. To very briefly answer the question that just popped up, will the slides be shared? Well, we are recording this event, so if anyone is interested to re-see the webinar, you can see it on our YouTube channel of ATILA Lectures, and there you will find also the slides.
Contact me. Feel free to contact me. I think my email is available, so I'll be very happy to follow up. If you have any questions, just write to me directly. I'm very happy to answer your questions.
Great. Thank you, Miriam.
My pleasure.
So I don't see any questions in the chat anymore. Then I think we can move on to the next presentation by Franziska ARNOLD-DWYER from Queen Mary University of London. As Helmut mentioned at the beginning, Franziska will give us a flavor of her newly released book, Insurance, Climate Change and Law. So now we'll take a look at this intersection of insurance and climate change from a more legal perspective. Franziska, are you ready?
Thank you very much and good afternoon. It's a great pleasure and an honor to present here today together with Dr. MARYAM GOLNARAGHI, and I thank the ATILA team for inviting me. So my first challenge is to get my slides. And here they are. Okay. But when we think about climate change and its impacts, then we tend to think of pictures like these: wildfires, flooding, and windstorm. And we think, well, is climate change insurable? And of course, the physical risks and liabilities in connection with climate change can be insured in principle. But insurers cannot prevent the occurrence of the underlying insured peril. However, paying claims for climate-related losses, of course, helps mitigate the financial impact of climate-related losses. But increasingly, we hear about that in certain regions of the world, climate-related weather risks become uninsurable because they're just too frequent or too severe for insurers to have the risk appetite, or they're only willing to offer cover for a premium that's not affordable. And this leaves protection gaps, which are not just a problem for the policyholder who can no longer buy insurance, or business that can no longer buy insurance, but increasingly that also becomes a problem for economies and for society as a whole. So in my book, Insurance, Climate Change and Law, I'm examining the role of the insurance industry is playing and how the role it should be playing in the global response to the threat of climate change and in the energy transition. So my book examines the legal and regulatory issues arising from insurance companies from climate change and the legal framework that governs to what extent insurance companies are required or permitted to take climate action. So when I sort of started sort of getting really interested in that topic back in 2019, I saw a lot of regulatory communications and articles on how banks and insurers should manage their financial risk from climate change. So that's the physical risk, the transition risk, and liability risk arising from climate change. And this is because these risks impact on an insurer's underwriting and investments, and they can have a negative effect on its financial sort of health and stability. So this is what I call the inward impact. And it was then that I had one of these sort of hang-on moments when I felt really strongly that there was something missing, namely that these sort of regulatory communications and articles, they didn't really consider it sort of the other way around, sort of in the sense, what impact does an insurer's business have on the environment and on climate in particular? And I didn't know back then that this was sort of the concept, that this concept had a name, double materiality. But as I was reading further into it, I realized that the sort of outward impact at that time was something that was really sort of under-examined and not really much talked about. But since then, it has become very much part of the conversation. And outward impact is also what I'd like to focus on today. But before we turn to the outward impact, let me very quickly run you through two regulatory issues that arise from the inward impact. So the financial risk arising from climate change on an insurer's balance sheet. There are two things. Where first, there's very broad agreement that climate change can materialize in financial risk to insurers in the form of physical risk, transition risk, and liability risk. And this is why many insurance regulators require insurers to identify, assess, and manage climate-related financial risk. So for UK insurers, a good place to start reading is the PRA's Supervisory Statement 319, and more recently, a Bank of England report from last year. And the EU has also addressed this in a delegated regulation. And as you'd expect, climate risk is assessed across all areas of prudential regulation, governance, risk management, regulatory capital, investments, and regulatory reporting. And then the second regulatory issue, and this is something that has sort of emerged over the last few years. We have seen a lot of climate and sustainability related disclosure requirements emerging, starting with the TCFD recommendations, a voluntary regime for climate disclosures that has now been replaced with the International Sustainability Disclosure Standards, IFRS 1 and 2. And in the UK, we see a very complex disclosure landscape for different types of insurers. There's sort of different requirements for different types. So every UK authorized insurer must disclose on TCFD compliance in its solvency and financial condition report. Listed insurers have separate requirements under the listing requirements. And there are sustainability related disclosure requirements in the FCA's ESG source book that apply to insurers that offer investment-based insurance products. And in parallel to that, we also have corporate disclosure requirements on climate-related risks under the Companies Act. And it's a similar picture in the EU, where we see the split between general corporate disclosures in relation to sustainability and disclosures that apply specifically to financial services providers and specific financial products. In the US too, there are sort of emerging disclosure obligations at state level and at federal level. So the SEC has proposed sustainability-related disclosures. And in California, California is leading the way with 2 climate-related disclosure bills. Now then, moving on to outward impact. So here we're looking at the business or the insurer's impact on climate and climate change. And it's important here to remember that insurers fulfill different functions. They're risk carriers, they're risk managers, and they are investors. And as such, they can have a beneficial or a harmful impacts to their actions and inactions in relation to climate change. Now, what are beneficial climate impacts? Well, you can sort of link this back to what to the goals of the Paris Agreement. So you could roughly break them down into actions that contribute to climate change mitigation. So that's sort of reaching the temperature goal of keeping the temperature rise to below below 2 degrees, and ideally to limit it to 1.5 degrees above pre-industrial levels. Then secondly, there are actions that contribute to climate change adaptation and climate resilience. So this is looking at increasing the ability to adapt to the adverse impacts of climate change that are already there. Climate finance, and then looking at harmful impacts that would be avoiding actions that contribute to greenhouse gas emissions and therefore would tend to contribute to further climate change. So my vision and that I put forward in my book is that of insurers as enablers. Insurers are not just risk carriers in relation to climate risk. They can be enablers of climate action who support their policyholders, investees, and other stakeholders in their own transition to a net zero economy. As risk managers, they can support climate change adaptation measures and foster resilience. And as investors, they can contribute to climate finance that is so essential to the energy transition. Now, I hear you say or think that's far too altruistic. Insurers are businesses that are accountable to their shareholders. And yes, that's absolutely true. And it remains the case that certainly in the sort of Anglo-American legal landscape, the prevailing view is that the corporate purpose is very tightly linked to the purpose of a company to create value for its shareholders. So I hear you, but let me explain. The Paris Agreement in its preamble very clearly sort of states that climate change is a common concern of humankind. So it's a global emergency that requires all of us to work together to find a global response. And the more recent UAE consensus coming out of COP28 makes it very clear that it's not just about sort of party countries agreeing on climate change goals. It's about recognizing the role of all stakeholders, including the private sector and specifically banks and insurers. And they must really step up, increase their ambitions and contribute to solutions towards lowering greenhouse gas emissions and climate resilient development. Now, this is also anchored in sort of theoretical frameworks. There's a lot of thinking about investor stewardship, and that's already an idea that's becoming embedded. It's the idea that as investor, you engage with and positively influence the board of the company you've invested in. So, for example, the UK Stewardship Code defines it as the responsible allocation, management, and oversight of capital to create long-term value for its clients and beneficiaries, leading to sustainable benefits for the economy, the environment, and society as a whole. There are also emerging ideas about stakeholder capitalism, which really expand the understanding of a company's purpose, not just being for shareholder value creation, but also along the lines of engaging stakeholders more widely and really recognizing that employees, customers, suppliers, local communities, and society at large, if they're sort of engaged and you create value for all of them, this also strengthens the long-term prosperity of a company. And of course, there are also various corporate social responsibility theories that sort of think about a company's responsibility in society, but also moving away from the more altruistic models. Insurance has also been sort of analyzed in sort of social sciences literature as a governance mechanism. So it is recognized that insurance can be used to steer risk behavior. And I think this is also an important aspect when we're looking at the role of insurance in relation to climate action and climate change. So now when I was planning my book, I had to come up with a structure. So I've been conceptualizing this in this sort of stylized diagram. So I've been thinking about the insurer's role in the energy transition in relation in its own operations. And that's probably the easiest category because you're fully in control in their own operations. Insurance companies are probably not the biggest greenhouse gas emitters. So there's only so much you can do. But then more interesting, you can look at the liability side, where on the product level, I'm particularly interested in, and I'm using green and brown here as sort of very crude terms for referencing beneficial action and harmful action, where you can look at insuring green, not insuring brown, and greening insurance. And I will go into these three categories in a minute. And then on the investment side, again, you can sort of look into investing green and investing brown. And then not to forget, there's a service level to it. So there's a lot of things insurance companies could perhaps be doing in relation to green risk management. So then as we are looking at insuring green, and I think this is where I follow on from MARYAM's presentation. This is about ensuring the transition, providing cover for green infrastructure projects, new energy systems and technologies during their build and development stage, and also during the operational phase. So it's really de-risking projects and lowering the costs of capital. And there are already products that are there, contractors or risk insurance, and in relation to the operational phase, there's of the usual operational insurances. And so it's really looking to how and whether we can use those products in the context of decarbonizing and pushing forward the energy transition. And it's I think what MARYAM said about her motto of no insurance, no investment, no project, no transition, that really rings true, because insurance is so essential in sort of de-risking the project in order for finance to be available and for projects to go ahead. I would also highlight there the supporting role of credit risk and political risk insurance. Often that's a crucial element for infrastructure projects in jurisdictions that are perhaps not so politically stable. And in terms of legal issues, but they're the usual issues you encounter in when insuring a big infrastructure projects of local regulations and licensing requirements. What documentation do you need? in terms of risk presentation, who is providing information and what this information is. Then you will have to think about co-insureds, who are the project parties, do the finance parties also want to be co-insureds, and then to whom are, if it comes to a loss, to whom are payments made? Do you need assignments? Do you need cut-through clauses if there's a reinsurance behind it? And also think about subrogation rights and whether waivers need to be in place. So this is of documentation issues, and there's this of well-oiled legal machinery in place for infrastructure projects. But as MARYAM highlighted, when we're talking about these new technologies and infrastructure projects relating to new energy resources, etc., it can be just that little bit more difficult, because it may relate to new assets, possibly counterparties you haven't dealt with before, risks that are not just straightforward risks, but correlate with other things that are perhaps difficult to predict, such as local regulation and policy. So there are complications, and ideally they should be anticipated in the documentation and as far as possible. MARYAM also mentioned a supportive regulatory environment, and in relation to green finance, there's an active debate on whether favorable prudential treatment should be accorded to green finance. Now, this debate is arriving in insurance, and here the question is, well, should regulators give favorable or preferential prudential treatment, for example, where insurance is used to stimulate environmental or social objectives. And the response of the Bank of England so far has been very clear. No, it is the answer. They say that an insurer's solvency capital treatment must be only based on a risk-based assessment, and environmental and social objectives are not necessarily reflective of the financial risk associated with an asset or activity, and if given preferential treatment, could lead to a deterioration of the safety and soundness of the firm. In contrast, EIOPA seems to be more flexible, or at least they're thinking about it. So there's a consultation going on at the moment on the prudential treatment of assets and activities that are associated with substantially with environmental objectives or harm. So it's open for a few more days. So if you feel if you have strong views on this, or you feel qualified to contribute, please do. And I think what EIOPA is particularly interested in is that sort of statistic or scientific evidence that can link climate risk to financial risk. So what they really need to see for giving this favorable or non-favorable prudential treatment is to see how sort of climate risk, but also climate actions feeds into the risk in relation to the solvency calculations of an insurer. Now, the flip side of insuring green is not insuring brown. So this is perhaps the most controversial area I'm going to talk about today. It's at the moment there's no legal requirement to withdraw from insuring carbon assets, and indeed, as long as the underlying carbon-related activities remain legal, there are really no legitimate grounds on which insurance for such assets or activities should be prohibited. However, those of you who work in London in the city you're probably all aware of climate activists that show up outside Lloyd's of London or other insurance companies basically branding insurers as climate criminals because these of underwriting support of carbon projects to the continuation of these activities. There are some signs on the regulatory landscape that may be indicative of the direction of travel in the future, possibly in the midterm or long-term future. So since last year, the UK regulators have been subject to a new regulatory principle, which is that they must consider the UK's climate targets, including the UK net zero goal in the exercise of their functions. Then at EU level, there is, of course, the EU taxonomy, which is very clear that an economic activity cannot be considered environmentally sustainable if it significantly harms the climate change mitigation objective. And we also have at EU level the Corporate Sustainability Reporting Directive, which requires disclosure of a company's transition planning for alignment with the Paris Agreement temperature goal, and also disclosure of any actual and potential adverse impacts connected with the undertaking's own operations and with its value chain on the environment. The Corporate Sustainability Due Diligence Directive, which suffered death a few weeks ago when it was not voted for in the European Parliament, would have also envisaged an active duty on large companies to bring to an end and prevent negative environmental impacts. But to give a balanced view, there are also countervailing trends. So in some US states, we see anti-ESG legislation that prohibits a state from doing business with financial institutions that boycott or discriminate against certain sort of assets, for example, that could affect insurance companies that are withdrawing from underwriting carbon assets. And there's of various other sort of boycott bills going on. So in any event, most people would probably agree that a sudden or disorderly withdrawal from insuring carbon assets might be counterproductive because it would endanger energy security, disrupt supply chains and industries that are still heavily dependent on carbon. But it could also lead to, say, tort victims and also employees potentially going uncompensated if there's some kind of loss. So for now, all insurers have to do is to account for their greenhouse gas emissions under the applicable disclosure regimes. But even disclosing their greenhouse gas emissions associated with their underwriting are not captured under the Scope 1, 2, and 3 emissions of the greenhouse gas protocol at the moment. So there are considerations and sort of discussions going on how insurance-associated emissions should be included, and the Partnership for Carbon Accounting Financials has put forward proposals which were adopted as in-scope emissions in the target-setting protocol published by the Net Zero Insurance Alliance last year. Now, coming back to climate litigation, could carbon underwriting be challenged in court? MARYAM gave us a very useful classification of climate litigation earlier, so including litigation for causal contribution to climate change or for non-alignment with the Paris Agreement goals. So could there be a lawsuit against insurers for contributing to climate change by supporting heavy emitters with insurance cover? But this would raise tricky legal questions of causation and attribution. There are no such reported lawsuits yet, But as I mentioned earlier, Just Stop Oil and Extinction Rebellion have been targeting insurers in London. And they certainly think that by supporting and deriving profits from harmful emissions, insurers are complicit in such harms. Just draw your attention to a couple of cases. Last year, we saw litigation involving the UK's Export Credit Agency, so UK Export Finance. The case was brought as a judicial review application by Friends of the Earth, and they challenged a decision by the government to approve an investment by UK Export Finance in a liquefied natural gas project in Mozambique on the grounds of unlawfulness. So they basically argued that this approval was ultra vires because it was not aligned with the UK's obligations under the Paris Climate Change Agreement. And it went to a first instance decision and then to the Court of Appeal. And the Court of Appeal held that the approval decision was lawful because it was within the range of reasonable decisions had been tenable for government to have concluded that the funding was aligned to the UK's net zero goals, etc. But permission to appeal has been given, so watch this space. And whilst this was a public law judicial review case, UK Export Finance is also providing export insurance. So it doesn't need a leap of imagination to see that underwriting decisions in carbon assets could potentially also be challenged. And the second case is an Australian case which did settle McVie and West, which was a case brought against a pension fund, and the cause of action was based on an allegation of failure to provide information on how the pension fund was managing climate change risk. And again, you can see pension fund very similar to what insurers do as investors. So we may not be many years away from that kind of action against insurers. And as for prudential treatment, so here the question would arise, should the regulator penalize insuring Crown? And of course, the PRA has and the Bank of England have said no, and the EIOPA is considering it. So then I'm quickly moving on. I know I'm sort of running out of time. So greening underwriting. Here I'm looking about how insurance products and services can shift policyholder behaviors and processes towards taking climate change mitigation, adaptation measures, and building their own resilience. So this can be done by adapting existing standard insurance products with green features and objectives, but also by developing new products and services. So in my book, I'm going through the whole life cycle of insurance products to see how they could be greened and what legal issues arise, what barriers there are, and how they can be addressed. And this is sort of a big chapter of my book, and I'm sorry that I don't have enough time today, but so I'm going through each stage and essentially very briefly at the product development stage and pre-contractual stage. The key legal issues center around product governance regulation, marketing, and anti-greenwashing rules. And very notably, we've seen EU legislation that requires environmental sustainability factors to be integrated into the product design and into the marketing process in relation to insurance-based investment products. We also need to rethink how we build in environmental sustainability into the pre-contractual risk presentation. So this will obviously depend on the type of insurance and the underlying assets. In relation to consumer insurance, we need to rethink how questionnaires should deal with that topic. And there is a scope, I think, for developing protocols and pre-contractual climate risk assessments that could raise awareness of climate risk itself, but also feed into climate action by insureds. Then as for using premium pricing so to be risk reflective of climate risk, well, this is an area where insurers could consider discounts, uplifts, or modular pricing, but it's also an area which is very sensitive, in particular in the consumer arena, where you have to think about fair value pricing and the consumer duty. And of course, premium uplifts could also lead to unaffordability and eventually protection gaps. One problem with pricing is also that it is, especially with climate mitigation action, it is very difficult to make this link between the action and a risk reduction for the purpose of a particular type of insurance, because the climate action might be too far removed to have sort of a direct impact on the risk. And it may be easier to do that with climate risk adaptation measures that have a risk reducing effect. Also, if you look at discounts, they may be hard to justify for the same reasons, where you don't see a direct feeding into a risk reduction. This is also not just an issue of causality, but also an issue of timing. Many climate action or measures, they may not have an immediate impact that percolates in a 12-month policy period. So we've got this time disconnect between the action and the benefit arising. And of course, with the 12-month policy period, the insurer who invests in a relationship, they can't be sure that the policyholder is going to renew with them after the 12-month policy period. And that, of course, then also feeds back into the whole discussion on corporate purpose and to the extent to which insurance companies should be doing good beyond mere value creation for their shareholders. Then for terms and conditions, that's a very interesting area. And when I was looking at the different options, so using warranties, exclusions, or so-called nudge terms, where you try to incentivize the policyholder. So just on surveying the legal risks there, I thought nudge terms were perhaps the best way to go forward. And also they do have precedent in other types of insurance policies, as for example in health policies, where health insurance policies, where good policy holder behavior is often rewarded. I also found a really good example just last week of a climate nudge term in the Nordic Marine Insurance Plan, which was recently amended. So this is a marine insurance framework of clauses that you can incorporate into a marine insurance policy. And one of the clauses relates to damaged ships and repairs. And the amendment to the clause is basically the basic clause is that the insured can choose the repair yard, the shipyard where a vessel is fixed. But the limit of the indemnity is limited basically to the amount of the lowest tender. So you have to get estimates and then go with the lowest tender. However, under this amendment, you can now take into account whether the lowest tender is a shipyard that complies with ESG standards. And it also takes into account how far you'd have to remove or tow the ship to get there. And there is a credit is being given if you choose a closer repair yard, because you'll use less fuel and cause fewer emissions. So I think that was a very good example of a nudge term. So, yeah, I'm running out of time, so I leave out green claims and replacement, and I'm also going to skip green investments. And I just want to leave you with a couple of thoughts on why insurers should be taking this enabling role that I've been advocating. And really, I think it was very well expressed by the Director of Sustainability at Aviva, who said, well, the insurance industry must act in order to stay relevant. I think this is very true, that the insurance industry has to stay on top of climate action and engage with policyholders, but also more widely in the way MARYAM has described, in order to sort of maintain this relevance and build trust and sort of be part of the climate solutions that we need to find, instead of being a bystander. So this is my book, and I'm very grateful to sort of all my colleagues in academia and the industry who helped me along the way, encouraging me and reading drafts, and also to my editors at Routledge. I think Guy Loft is here today, and also to my institution, Queen Mary. They've also supported me with funding, but also by sending me to COP27 and COP28, and most of all to my family, who supported me through 3 years of agony. And so with that, I say thank you very much and hand back to Marta.
Thank you very much, Franziska. I really regret I had to interrupt you, but I feel, you know, we could have this conversation and your presentation for the rest of the day, probably. I must say I was really looking forward to reading your book the moment I knew it was released, but now after seeing your presentation, I know I want to read it right away. Because let me just say it is really difficult to find a comprehensive analysis of the role of the insurance market, insurers, in fighting climate change, achieving global climate targets, specifically from a purely legal perspective. We all know that insurers have a huge potential to play a role in fighting climate change, but you know, I always miss the answer to the question of how. How exactly insurers can help in achieving those climate targets? What exact actions may they take? And it seems to me that in your book you managed to achieve this goal, you know, to answer the question of how, which is great. But now very quickly, getting back to your presentation, one of the core ideas you presented was insurance as enabler of climate action. And I believe we all can support the idea. We agree that insurers should take actions. But a question that I found relevant, especially or important to be raised, especially from the legal point of view, would be if this is appropriate for insurers, you know, to engage as enablers. Why should they engage? Which to this question you very briefly answered in your last slide. But also, does the currently binding law allow for such engagement? If you could just briefly give an answer. And there's also one question from Alberto Monti in the chat. So if we can allow, you know, for this webinar to take a little bit longer, that would be great if everyone agrees.
Well, thank you, Marta. And so in my book, I don't have all the answers, but what I was hoping to do is to highlight the legal issues around it, and also give some thoughts to how some of these legal issues could be addressed, either through contractual mechanisms, or where perhaps regulatory change is needed. As for why insurers should engage and are they allowed to do so, well, the way I see it is that climate change is a global emergency, and it requires everyone to contribute. And I would argue that strategically the insurance industry must take this role to stay relevant and for its business model to survive. So take the example of climate-related natural catastrophe insurance cover, where we see this trend of insurers withdrawing capacity. So as climate risk builds up, insurers might either pass on the costs of higher claims into premiums, or they might refuse to renew insurance for high-risk policyholders. So if they don't respond effectively, this is just going to sort of produce a drag on their business and their profitability and erode their market share. And then in turn, it sort of could then sort of lead to sort of financial vulnerability. So helping their policyholders to build resilience to climate risk and to reduce greenhouse gas emissions is really in their own interest because it reduces their own exposure. Now, I do understand the limitations, and as I said, sort of the way corporate purpose and the director's duty is phrased and how the capital requirements operate, they put some limits on that. But I do think, as MARYAM said, this is not just a challenge; it's also an opportunity.
MARYAM, are you raising your hand?
I wanted to just give a comment on this. I don't think this is just an issue for the insurers. About 5 years ago, we took a deep dive into flood risk management systems. And, I think when you tackle this issue of insurability of physical risk and role of insurers, you have to first look at, well, who is creating the risk and who has a direct responsibility to actually manage the risk with a preventive or with a, sort of reduction approach. And ultimately, the point is it's to everyone's benefit to keep insurance live and affordable in the market. So I'm launching a major initiative in May where I'm going to be looking at the housing market and the relationship to mortgage and lending and asset valuation, and take a deep look at where the sources of risks are and essentially how different stakeholders, from the homeowner to the mortgage lender to the real estate, et cetera, to the government, who has what role to play to reduce or prevent the risks. So it is to everybody's. So let's not just put this on insurance companies because they do want to stay in the business. Okay. I think the key is it's to everybody's benefit to have insurance. So we need to move towards a risk-based, system-based approach to reducing and preventing risk to keep insurance viable. So I think we need to shift this paradigm, discussion from just putting insurers in the line of fire and think about the whole system of risk generation and risk reduction and prevention with the interest of keeping. And then the second part is we already have built in very high risk areas. So as in the last 5 years, I've been heavily involved with Government of Canada to reform its flood risk management and insurance system. And unlike anywhere in the world, in fact, there was the development of flood insurance markets where the government insurance industry has been working on zoning the regions based on very high risk, where government is taking pretty dramatic measures to even call for moving people out of it by buying out the homes, to regions where there are public-private partnerships in providing insurers because still the risk is high and commercial insurance markets can't handle it. And then there are regions where commercial markets. So I think it's not such a black and white simple question. Again, it's going to require system-based, risk-based thinking where we look at where the risks are generated, how we can manage them, and who should manage it with the intention of keeping insurance affordable and accessible in the market. So again, if there is interest from anyone in the group, let me know. I'm launching this in May, and it would be a very serious. We will do the same thing for industrial plants and infrastructure systems as well, as we are investing trillions of dollars in decarbonizing the economy. Are we building these industrial plants in places where 10 years down the road they can get insurance or not? So that's going to require pretty serious intervention in the way we are doing project development and finance. Selection of the location of building the industrial plant and infrastructure system does not incorporate long-term analysis of physical risk. So again, you know, we have to start putting a different hat on and say, are current thinking the right thinking, or do we need new ways of thinking, and how to enable that on the ground? Thank you.
Thank you, Maryam, for this comment. I want to allow for one last question that we have in the chat. And maybe, Franziska, miraculously you'll find a way to very briefly answer to this question, okay?
Sorry, I'm just reading it now. Do you
okay.
agree with the idea that with the future enabling adaptation private insurance? Yes, my answer is yes, Alberto, and I was going to cover this in the slide I skipped. So I think Build Back Better in relation to claims is an important concept, but it's as always it's the question, well, who pays for climate action? So Build Back Better is likely to cause additional costs. So you have to consider, well, is that something that should be borne by the policyholder under of the idea of betterment, or is it the insurer, or is it the state, so the taxpayer? And there may be mechanisms for where for specific assets, government grants or subsidies are available. Whether you could perhaps integrate this into Build Back Better via subrogation mechanisms. You could even write it into your insurance contract with some kind of clawback clause. So the question remains, yes, it's a good idea, Build Back Better. And Flood Re here in England, they have sort of started to do something along those lines. So where you get extra funding to sort of flood-proof your house once you're flooded, etc. There is also sort of other sort of legal questions to do with sort of the so whether it's the policyholder or the insurer who should have the choice of electing it, and perhaps whether you could make this sort of a modular element in your insurance policy and perhaps finance it with an additional premium. But then you'd also have to look into whether there would be any take up for it. So absolutely, green claims and Build Back Better is an important element.
Thank you. Maryam, one last word.
Yes, I just wanted to comment on some of the developments here. So the new wording is not built back, it's built forward more resiliently. So go figure, you know, the cliches that are coming one after the other. But one of the things I wanted to raise is the post-disaster aid program of governments. You know, a disaster happens, the government declares a state of emergency and funds becomes available. So there is a lot of studies right now, including some of the work that I've done in Canada on how to reform the post-disaster aid programs of the government. Because when you actually look at where this money goes usually to the municipal government for building back or for fixing infrastructure systems that are owned by municipal government, as opposed to the homeowner. What goes to the homeowner is very little. So the issue becomes, you know, can we reform, for example, as one of the mechanisms, by the way, the post-disaster program, which actually disincentivizes insurance, because people say government is going to pay, why should I buy insurance? So to reform the post-disaster aid programs to, number one, help open up insurance markets so people can actually buy insurance, but that money can start becoming conditional for municipal governments, that they should show a plan for building resiliency in their systems and a plan that is preventive in allowing for building in high-risk areas for them to qualify for the funding. It's very complex, as you can see, legally and everywhere. It has a lot of challenges, but at least the ideas are there to think about who is creating the risk, what is the source, and who has direct role in mitigating that, and how to leverage different sources of funding in a new way to incentivize what Franziska has said. So I think these discussions are underway.
And I think there's also one further development in this area, which is advance payouts. So where basically insurance pays in advance of a loss. And I know that sounds like a heresy to insurance lawyers, but it's the idea of spending money in advance to prevent or mitigate the impact of the loss. So prevention is better than cure. And this money is then being utilized to, I don't know, flood-proof or storm-proof property. And then once the physical risk arrives, the loss is not as severe as it would have been.
I see we have some other raised hands. And one more question. I'm not sure if we can go. The time is up. Helmut, do you think we can still afford a couple of questions?
I don't think we can go for a couple, but I think we can go for the one that is in the F&A section.
Okay. The slope for insurers to refrain from insuring climate change driving trades is a slippery one, especially since compliance and antitrust harbor above a sudden change. Do you see a legal baseline to build a strong case to protect insurers from such claims? MARYAM, Franziska, who do you want to take? Who wants to take the question?
Well, are you referring to the well, not the demise, but the issues experienced by the Net Zero Insurance Alliance last year? So there was a Net Zero Insurance Alliance with a grouping of insurers, and amongst other things, they had set themselves certain targets of reducing emissions and moving towards net zero. And they unfortunately were targeted by a group of US Attorney Generals last year, alleging or inquiring into whether that kind of grouping would raise antitrust or competition issues. And I think at the time there was a lot of commentary how these allegations were unfounded, but nevertheless it caused some members to leave the Net Zero Insurance Alliance. So I know that some regulators have started looking into exceptions for competition and antitrust laws, which specifically permit certain what they call sustainability agreements, so collective thinking around sustainability, so as not to be accepted or excluded from competition issues. But it's an area that is very political, and it does pose a legal risk.
Okay, thank you, Franziska. MARYAM, do you have anything to add to it?
Unfortunately, I have to leave you. I'm so sorry. I have a meeting that starts in 1 minute. But
Don't worry,
hopefully in the future we will have. Thank you so much. It has been an absolute pleasure.
Thank you very much. Thank you.
Thank you.
Also, thanks to everybody for being today with us. Time is up for a long time now, 15 minutes. But like I said earlier, I feel, and I think everybody can share, we could continue this discussion for a very long time still. So thank you very much for your time. Please remember to follow our next ATILA event. Helmut, do we have details about the next lecture?
Well, we have this much. It will be in September. and you will be informed about the precise date that will be fixed very shortly in due course. And the topic will be on insurance-based investment products. There's a lot of things going on this topic in the European Union, and it will affect, of course, the regulation of insurance-based investment products. And there is equally a lot to say about the situation in the US. So it will basically be a comparison between US and EU law. And well, we hope to see you again there. Be back with us. In the meanwhile, keep the spirit, and thank you very much for being with us today.